Rach, we mentioned at the top of the episode equity. Do you want to maybe give us a bit of a 101 about equity?
Yeah, sure. So your equity that you have in a property, so when we're relating to property, it's the difference between the value of your property and I would say minus the mortgage that you have on that property. So let's say you have a property that's worth $1 million today.
I'll get you to draw it for the people watching.
Yeah, sure.
And just explain how equity works, because it's a really important thing to understand.
Yeah, it is. I would say it's one of the most important things when you're talking about property and buying property is to understand equity and maybe even the difference between equity and usable equity. So I'm just going to draw a house here, and let's say this whole house is worth $1 million.
Awesome.
And I'm going to put what usable equity is. So you can't, if you've got a house worth $1 million, you can't go and lend $1 million on it. So we're going to say 80% is the usable equity, and that's...
And that 80%, that's the magical number that you won't have to pay lenders mortgage insurance for and...
Look, and so that's your usable equity on this property is $800,000, but there's a lot of people at the moment that are borrowing 95% of the value of properties using the 5% guarantee scheme. There's also people who would borrow up to 90% without mortgage insurance in certain industries. But just for simplicity, I'm going to say 80%. So let's say you've got a property worth $1 million and the usable equity is $800,000. And let's say your mortgage here, let's say you've got I'm terrible at drawing these, $500,000 mortgage. The difference between your mortgage and the usable equity here is $300,000. So you've got $300,000 in usable equity, which is $500 your mortgage, $300 is your usable equity left, and the $200 is the stuff that the bank won't lend on without mortgage insurance or extra fees.
So that 20% the bank quarantine. So if the property market tanks at the time and at that same time you can't pay your mortgage, they know the property market probably hasn't tanked more than 20% and they'll be able to recoup the money from selling the property.
And when we talk about this in lending terms, we use the term LVR, which is loan to value ratio. So in this case, we're saying usable equity is 80%. That would be if you had a mortgage of $800,000 on $1 million property, your LVR is 80%. If you had this same property worth $1 million and you borrowed $950,000, your LVR would be 95%.
So that's the 101 on equity. And on the right-hand side of that laptop, if you just press it with your finger, why is equity so important? And particularly, you touched on at the start with people have bought property and the prices has increased in the last 12 months. Why is this equity so important even within 12 months?
That's right. So when you buy a property, and your LVR at the time you buy is important because banks price for risk. So let's talk about rates for a moment. Let's quarantine it and talk about your mortgage rate. If you buy a property today and you borrow 90% of the value of the property, the bank might give you a rate based on a 90% LVR, but they may have given you a lower rate if you only borrowed 80%. Now, if you bought a year ago and your LVR at the time of purchase was 90%, it very well could be 80% now. So if it's 80% now, it's the time to renegotiate your rate because you've got more equity than when you purchased it.
So, for example, if someone did traditionally went and got a normal home loan, and we'll just, for round numbers, $1 million purchase price, they put $150,000 in.
Yep.
Right? So what we got?
They borrowed 85%.
Yep. If, for example, in the background, the bank or lender would have a thing to say the interest rate based on an 85% lend is 6.2.
Yep.
And then the next line, interest rate on a 80% lend might be 5.8.
Yes.
So what you're saying is over the course of a year or 2 years, the equity can do some heavy lifting. So if the mortgage was re-reviewed, there is more equity, lower LVR, so that fits into the lower interest rate band because there's less risk for the bank because they're lending less.
That's right. So I'll give you an example of one that I looked at this week. So this person had their own home. and I can't remember off the top of my head what this home was worth, but they had a mortgage here. That was their mortgage. And then they bought an investment property here last year. And when they bought that investment property here, and I actually can't remember what it was, but let's say they bought it for $600,000, and let's say they borrowed $420,000, so 80% against this property, and then they put the 20% plus costs against their home. So this is sitting here at 80%.
So the standalone new investment property is 80%.
That's right.
Yep.
Now forget all about this home loan here. This property was worth $600, increased in value quite substantially over the last 12 months. And this LVR isn't 80% anymore because these standalone.
Yes.
It's now 60%.
Right.
The rate was 5.94 when they got their mortgage a year ago, and they've just renegotiated with the same bank down to 5.59 for interest only. Investment lending, which is 0.4 less. So they're actually going to be saving $2,800 a year on this mortgage because this property went up in value.
So the investment property, they got the investment property, it was a higher interest rate because the LVR was 80% secured against the home. A year later, the investment property increased in value, and then they could then reassess the investment property because there was more equity in it and get a lower interest rate.
That's right.
Yeah.
That's
and
right.
I'm mansplaining back to myself so I understand.
So even if you put this in a more simplistic way, even if you were, just a first home buyer and you bought, and let's say you bought for, you had a 5% deposit and the rate was a certain percentage on that 95%, well, that rate might be a little bit higher than what you could get if it was 85%. So if you've bought a house, it's your first home and it's gone up 10% in value, well, then you should, in essence, be able to get a better rate now than when you're at 95%. Now, that's just talking about rates. Equity can give a whole lot of other things, like the ability to buy another property or take money out for other things or renovate your home. But I think one of the most prevalent right now is the release of guarantees, both the government and parental.
Yeah. And we'll talk about that later in the episode. Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.